the Great Rotation, and the era of corporate frugality. The era of burning cash is officially dead. While you were watching ChatGPT, the smart money was betting on corporate frugality. In a shocking market rotation, investors just dumped high-growth tech like CrowdStrike and Cloudflare to chase boring companies that actually make a profit. It's not a crash, it's a reality check. Here is why frugal tech is the only way to survive 2026. Monday, February 23, 2026. The opening bell at the New York Stock Exchange didn't ring with its usual optimism. Instead, a heavy silence fell over the tech-heavy Nasdaq. Senior business reporter Ines Fair captured the mood in a single, haunting sentence: money's moving out of tech. For years, investors treated big tech like an ATM that never ran out of cash. But today's board is bleeding red. Microsoft is down. Zscaler is shedding over 5%. CrowdStrike and Cloudflare are in a freefall, both dropping nearly 8%. Even the energy giant ExxonMobil is feeling the squeeze, down over 2%. This isn't just a bad day at the office. This is the AI scare trade. It is the moment the market realizes that the growth at all costs model is dead. In its place, a new, humbler philosophy is rising: corporate frugality. Act 2. The death of the blank check. Why the AI hype hit a wall. Between 2023 and 2025, if a CEO mentioned AI in an earnings call, their stock price jumped 10%. It was the era of the blank check. Companies were spending billions on H100 chips and LLM training without a clear path to profit. But by early 2026, the scare set in. Investors started asking the frugal question: where is the return? Wall Street is now weighing the winners based on capital discipline. The companies being punished today, the Zscalers and Cloudflares, are those perceived to have bloated valuations. The market is no longer interested in how much you spend in AI. It is obsessed with how much you save using it. We are shifting from an expansionary phase to a defensive, frugal posture. Act 3. The frugal tech revolution. Efficiency as the new alpha. What does frugal living look like for a multi-billion-dollar tech titan? It looks like the efficiency trade. The new winners are the lean machines. Investors are rotating into companies that have mastered the art of doing more with less. Server optimization. Instead of buying more hardware, companies are using AI to squeeze 30% more performance out of existing chips. Headcount discipline. The massive hiring sprees of the early 2020s are over. The frugal tech winner is the company that grows its revenue while keeping its employee count flat. Energy frugality. This is why ExxonMobil and the energy sector are being watched so closely. In an era of high power costs, the most frugal company is the one that consumes the least electricity per computation. The scare trade is effectively a waste scare. Investors are terrified of companies that are burning cash on AI, experiments that don't move the needle. Act 4. The catch-up trade and the value shift. Old money, new discipline. Narration. As money exits the expensive tech sector, it is seeking refuge in the catch-up sectors. These are the industries that have practiced frugal living for decades: utilities, manufacturing, and logistics. These sectors didn't have the luxury of 40x P/E ratios. They had to be lean to survive. Now, they are using AI as a tool for extreme frugality. They aren't building chatbots. They are using AI to predict when a machine part will break, saving millions in maintenance. They are using AI to optimize shipping routes, saving billions in fuel. Wall Street is weighing these winners because their growth is sustainable. It's not based on hype. It's based on margin expansion. When a frugal, boring company adopts AI, the impact on the bottom line is often more dramatic than when a tech company does it. Act V. Psychology of the scare. The fear of the overcrowded room. Narration. Why is the sell-off so violent for stocks like CRWD and Net? Because everyone was in the same trade. It was a crowded room when the first sign of a frugal winter appeared. Everyone rushed for the exit at once. The AI scare trade is a psychological pivot. It's the realization that high-flying tech stocks are luxury goods that the market can no longer afford in a high-interest rate, high-energy cost world. Investors are moving toward budget-friendly stocks companies with low debt, high cash flow, and modest valuations. This is the ultimate form of market frugality, buying value, not dreams. ActVi, the 2026 Outlook, the Lean Frontier. Conclusion and future proyection. Narration. The update from February 23, 2026 will be remembered as the day the AI party got its first audit. The money isn't leaving the market, it's just getting smarter and more frugal. The winners of the next decade won't be the ones who spent the most. They will be the ones who used AI to become the most efficient versions of themselves. Wall Street is currently weighing the winners of the lean frontier. As an investor, the lesson is clear. Stop looking at the top-line revenue and start obsessing over the bottom-line profit. In the AI scare trade, frugality is the ultimate competitive advantage. The rotation is painful for those holding the old hype, but it is necessary. It is the market's way of forcing tech to grow up, pay its bills, and prove its worth in a world that no longer accepts potential as a currency. Act 7. The Macroeconomic Cold Front. The Ghost of Inflation and the Interest Rate Anchor. Narration. To understand why Wall Street is suddenly obsessed with frugality on this Monday in February 2026, we have to look at the anchor holding back the tech balloon: interest rates. For a decade, tech companies lived in a world of free money, when borrowing costs are near zero. You don't have to be frugal. You can spend billions on speculative AI research because the cost of waiting for a profit is negligible. But 2026 is different. The AI scare trade is amplified because the cost of capital has remained stubbornly high. When Microsoft MSFT dips, even by a fraction of a percent, it reflects a massive recalibration of discounted cash flow models. Investors are looking at the billions Microsoft has poured into OpenAI and asking, if we can get a 5% guaranteed return on a government bond, why are we waiting 5 years for an AI profit margin that might never materialize? This is the macroeconomic cold front. It has frozen the venture capital markets and forced public companies to adopt a survivalist mindset. The drop-in scaler and CrowdStrike isn't just about their product quality. It's about the market realizing these companies have to pay more to grow than they did 18 months ago. Wall Street is weighing winners based on interest coverage ratios, a boring, frugal metric that hasn't been this important since the early 2000s. Act 8. The retail pivot: frugal living at home. The consumer connection to the scare trade. Narration. There is a poetic irony in the AI scare trade, while Wall Street firms are dumping tech stocks. The average consumer. The person behind the trade is practicing their own form of frugal living. High cost of living pressures in 2026 have changed consumer behavior. People are no longer upgrading their AI-powered smartphones every year. They are keeping their hardware longer. They are canceling redundant SaaS subscriptions. This consumer frugality is hitting the top-line revenue of the very tech companies that were supposed to be recession-proof. When Ines Fair notes that money is moving into sectors that have been playing catch-up, she is talking about the staples investors are moving into companies that sell things people need regardless of the AI hype: food, basic energy, and physical infrastructure. The scare is that the AI revolution forgot about the bread and butter economy. Wall Street is now betting that the next big win isn't a new algorithm, but a more efficient way to deliver a gallon of milk or a kilowatt of power. Act 9. The Infrastructure Renaissance. The boring winners of the catch-up trade. Narration. Let's look closer at the catch-up winners. These are the companies that were ignored while everyone was buying Nvidia and Microsoft. The grid builders. AI centers consume more power than mid-sized cities. The winners are the utility companies that have spent the last 5 years being frugal and upgrading their grids. They are finally seeing a massive surge in demand. This is a catch-up because their stock prices have been flat 4 years while tech soared. Now, the roles are reversed. The logistics titans, Companies like UPS or FedEx and their global counterparts are using Frugal AI. They aren't trying to invent Aggie. They are using simple machine learning to save 2% on tire wear and 5% on fuel. In a multi-billion-dollar operation, that frugality results in massive profit spikes. The old security, while Cloudflare Net and CrowdStrike CRWD are high-growth cloud security. Investors are looking back at physical security and legacy systems that have proven resilience. The 8% drop in net suggests that the cloud-only narrative might have been overbought. Act 12, Final Summary. The New Equilibrium. Narration. As we look back at the data from February 23, 2026, the rotation isn't a sign of failure. It is a sign of market maturity. The scare is simply the ghost of the 2000 dot-com bubble, reminding us that valuations eventually have to meet reality. The money isn't leaving tech forever. It is simply moving into a more frugal version of tech. It is moving into the companies that help us live better, cheaper, and more efficiently. The catch-up winners are the heroes of this new era, the companies that build the world we actually live in. Powered by the AI we once only dreamed of. The appetite has shifted. The era of the blank check is over. The era of the frugal winner has begun. In the end, Wall Street always returns to the same truth. Profit is a fact, but hype is only an opinion. In 2026, the market chose the facts.